Hello, everybody, and welcome to Confident Compounding with Corey Kramer. Today, we're going to be analyzing MNDY stock, ticker MNDY. This one came in by request down in the comments of one of my other videos. If you have a request, put it down in the comments. I usually go through those about once a week and put the requests up on the chalkboard. I am making progress here on the requests. If you have one, I'll either post the video here or on Patreon on the free tier. I have a free tier over there, so go check that out. Usually the smaller ones I'll post over there because probably not too many people will watch them on YouTube anyway. As always, not individual investing advice, just how I analyze stocks. So MNDY.com, they are a software company. Let's see how they are described here in the fast graph summary. So engages in the business of operating cloud-based visual work operating system that consists of modular building blocks that can easily be used and assembled to create software applications and work management tools. So software company based out of Israel, I believe, Tel Aviv. Yep. So I bought this not a couple years, like a year and a half ago, as part of my fast growth strategy. Let's see, it was about here in May of 2024. So it's down a little bit now in this last dip. But it was doing pretty decent until recently. The stock price is down. Let's see. Peaked around, actually might have peaked back here at like 325. And what are we at now? 150, yeah. So more than 50% off the top. I'm not down quite that much. And no real damage yet, I would say, to earnings. But it was trading at a very high valuation. So even when I bought it, again, it was the growth strategy. So I kind of put up with these high valuations. And when you do that, you need probably like 3 years of really good growth for it to get at a normal valuation, or assuming the stock price doesn't fall, which is what has happened here. But at the peak, it was trading at 100 PE, right? So you really have to blow things kind of out of the water in order to maintain that sort of valuation, right? And I think what we have going on here is probably some like AI fears. A lot of software companies have been trading down recently due to that. But I'll perform a time until payback analysis and we'll take a look at it from an earnings standpoint. Now, my fast growth strategy doesn't use earnings. It tries to basically find good growth businesses a little before earnings really show it. And then sometimes I can get really good deals that way. The risk, obviously, is you have some where the earnings don't ultimately come through over the medium term, long term, like 5 years or so. And so you kind of balance out and you have a lot of volatility too when you pay a high PE like we have now. So the PE right now is about 36, so still pretty high, right? It's not like it's cheap, even though earnings have grown. We'll take out this first year. They grew like almost 100% in 2024 and then another 20% in this year is what they're on track for, which is totally fine. It's more a question of how long they can keep that 20% annual growth. And so they're only a $7 billion company. Again, a software company. So in theory, they have a room to run. It's just a matter of execution and whether they are one of the winners in doing what they do. So I think we can move on just to the valuation now. So for the earnings valuation, what I'm going to do is I'm going to pull forward since we're almost into 2026 anyway, I'm going to pull forward the earnings expectations for next year. And then what I'm going to do is see how long it would take investors to earn their money back if they bought right now, to earn the amount that they spend via earnings, right? So if you bought the company for $100 today, how long is it likely to take you to earn back $100 from the company's earnings and earnings growth? Usually I'm looking for about the 10-year mark roughly. So 9 to 10 year payback is what I usually would want on an earnings based analysis like that to have a good deal. I want to earn my money back sooner rather than later. S&P 500 is going to be closer to like 14, 15 year time until payback right now. If you were just to buy it, but it's a little skewed because of, the, the AI stocks and everything. But if you did like the equal weighted S&P 500, that's around where it's at, give or take. Just for some reference, right? And I would say, like, if it takes 15 years to earn your money back, that's when I would think about selling based on valuation. If it's kind of 12 years, 13 years, that's kind of like a hold range if I already own something. So in order to make that calculation, we need an earnings, which I already told you, an earnings growth number, an earnings yield. And the earnings yield is just the PE ratio inverted. So it's going to be the earnings over the price instead of the price over the earnings, but it's really the same thing. And I also need an earnings growth rate, which is going to be the real thing that you have to. So like right now, they've been growing earnings 37%, or if they do what they're expected to the next couple of years, they've been growing earnings like 37% rate. I think I'm going to use 20% is my assumption here. So next year, I guess they're only supposed to expected to grow 14, but then they're expected to grow 29. So that's about on par with 20. 20 is about what they did this year. So you have to step back and say, I think I max out at 20. Like I never assume faster earnings growth than 20%. That might be, well, it's hard to say. They could grow 20% for the next 10 years, 20% per year. Maybe that's a little aggressive. It kind of depends on what happens, with the economy and everything else like that. But I think it's probably maybe on the edge of optimistic. Maybe 15% would be more conservative to use. I could potentially take a look at that growth rate too, but I'm going to go with 20 because, that's half of what they've been doing, but realistically, I try to be realistic. You don't want to have your buy prices too low because then you never get a chance to. Some people think mine are too low, but I bought like 50 stocks over the past year. A lot of them were kind of like Monday here. So I have a 20% growth rate. I'm going to assume they earn $4.88 per share. That works out to an earnings yield, and I'm going to pull forward the first year's growth too, and then that works out to an earnings yield of 3.19%. So the way to think about this is if you paid $100 for the business, you'd earn $3.19 the first year in earnings to work toward earning back your $100, right? And then I'm going to assume that grows 20% the first year too. So, and we'll get into those. So that's what the spreadsheet's designed to measure. So yeah, that first year I assume on your $100 investment, you earn $3.82. And you get to keep that. And then the next year you earn $4.59 on your $100 and you get to keep that. And the next year, $5.51. And it grows at 20% each year. And it crosses that threshold at about 11 years. It was what it would take you to earn $100 on a $100 investment. Not too bad, but like I said, 20% might be on the optimistic side. I can plug in 15 real quick and see. It would take 12 years, so an extra year if they grow a little bit slower. So nothing too crazy there. If you're going to wait for it to get below 10 years, which is what I would prefer, that happens at about $121 per share. So that would be kind of the initial buy price using this method, which actually really isn't very much lower than where the stock's trading at 153 right now. So it's pretty close to kind of that buy zone using earnings. The one caveat that I would put in is we have a lot of dangers going on, which maybe the market's overreacting, but we're just now getting down to kind of the 30s PE. It definitely go lower than that, especially if earnings slow next year or go slightly negative. So if I was buying, I do own this one, but if I was buying with new money, I would also probably wait for this to cross like the 200-day moving average before I bought it. So let's see if I have a quick, it keeps hiding my graphs for me. Well, There we go. See if I can pull it up. There it is. So right now that's at $246.74. So well below. You can see it just broke down below that. So really what I would want to see happen is it, as a buyer, not as an owner, which I am, I would want the stock to go down maybe to like this 120 level or a little below that, level out down there, and then get some kind of momentum going back up the other direction. And then over time, this 200-day moving average will come down, and then it will cross that, and that will be a sign, okay, not only is the valuation good, but the momentum is starting to pick up. And that would be one of the safer times to buy it. You can also maybe buy like half on the way down at that 121 mark, and then save the other half for when the momentum looks good. Either I've used both styles. I would say at the macro, I'm a little more bearish right now, so I kind of lean toward just waiting until the momentum looks good. But if you have a lot of cash, or you really like the business, buying like half on the way down when the valuation's good, and then half once it looks like it's really bottomed. It would be like during this decline, if you bought a position here and then it came and bottomed, and then you could tell it was coming back, then you say, okay, I'm going to take my next position, and then, you hold from there on out. So that would be my strategy with Monday. I don't really have any insight into how it's going to turn out for them. If AI agents and everything can do all the stuff that their software can do. What I've read is people really do like their software, and their kind of modules and everything. But again, like if you have an AI agent that can do that better, or in your software becomes obsolete or just not as desirable, then it might not work. So there's a pretty wide disparity, I think, in terms of the potential outcome for this stock and almost anything like it right now. And so, maybe just usually I bring in portfolio considerations when that happens. How many of these type of software stocks do I already own? If it all fell apart, what does that look like? And if I don't have very much exposure at all, then I might be more willing to take a chance. So around the edges, kind of those are the things that a person should probably be thinking about. I'm okay just accepting that I don't know. A lot of people are not. They want really hard conviction one way or the other. I find that usually ends up costing more money, because you tend to add more to the things that you were wrong about, that you haven't fully admitted you were wrong. So I might end up being wrong about this one. I'd rather keep that mindset, and know that the metrics looked good when I bought it. A lot of times when all those things kind of align, it works out well. But there are times when disruptors come along, like AI, that could just change everything. And so I try to take small positions and have a good methodology, and, kind of practice that with an open mind, and understand some of them aren't going to work out, but maybe all my chip stocks or whatever, which have been flying, do really well, right? Because that's the flip side of it. And so I don't have super strong opinion about this one, but I do generally like it. I mean, I did buy it and I haven't sold it yet. And I'm probably just going to hold for another, year or so, and we'll see what happens. All right, everybody. Thanks for watching. If you have a request, let me know, and I'll see you later.